want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions. Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and here with me today is Justin Onakosi, Manager of the Multi-Asset Funds for Legal & General. Hi Justin.
Hi.
So I know your funds are very thematic driven, very macro driven. What exactly is your outlook for the global economy going forward?
So firstly, we take a 1 to 5 year view in terms of time horizon. So in 2015, our outlook is that global growth will be very strong, so stronger than expected. And this is really driven by the US, where we believe that compared to consensus, our economic growth forecasts are much more positive. What does this mean for asset classes? It means we're overweight risk assets. So we're positive on equities, typically negative on bonds, and positive on UK property.
Looking at the US, that's quite a contrarian view because a lot of people are saying that actually the US is looking like it's fully valued.
In terms of US equities, I agree, but in terms of the US economy, we think that the US economy is going to grow much more than expected, really driven by an increase in capex, falling unemployment, and I think you'll start to see a tightening of the labour market. Our view is that globally, particularly in the UK and the US, deflation has been defeated. So where we were kind of really worried about deflation on both sides of the Atlantic, we now think that's troughed, and you're going to start to see inflationary pressures, but you're going to see growth as well.
And how does that trickle down into how you run the fund then? You say that you think the US economy is really strong, but then you also admit that you think, US economy is very strong, but US equities are overvalued. So where does that lead you then as a fund manager?
So we're positive on equities, and we think the US is, the global growth engine of the world, and will pull growth up throughout the rest of the world. In terms of positioning within the equity market, we're very positive on emerging markets. We believe that monetary policy flexibility that they have is much better than developed markets. So, for example, if we are wrong and there is a global shock, they still can reduce rates. The demographics in emerging markets are very strong. Growing middle class, growing urbanisation, and also from a valuation perspective now, emerging market equities are looking more attractive than developed market equities.
And what about Europe then? Because Europe's had a bit of a tough time. There's been some attempts to get it going again. They've been a sort of muted response, haven't they?
Yes, I've been saying for a long time to anybody that will listen that Europe is definitely the elephant in the room. Deflation or low inflation is a serious problem in Europe. And as we know, the ECB tend to only react when they really have to. And therefore, we think that if inflation remains at such low levels in Europe, you will see an ECB response. I think something that's very interesting actually in 2015 is the difference in policy from the Bank of England and the Fed versus the Bank of Japan and the ECB. So whilst you're going to see the Fed and the Bank of England look to start increasing rates in 2015, it's quite clear the Bank of Japan and the ECB are going to have to continue to ease their monetary policy.
You are a multi-asset fund manager. Although you said that you're sort of bullish mostly on equities, where do you stand on bonds? Presumably you have to make up a part of your portfolio in order to counter risk.
That's a great question. So in terms of defensive and cautious investors who've typically relied on gilts, we think they're going to have to do really two things. First, they're going to have to diversify away from the gilt market into other safe government bonds. We've learned since 2008 that even safe countries can be downgraded. France has been downgraded, the UK has been downgraded, even the US, the global engine room of economic growth has been downgraded. So it's important to diversify. Secondly, I think you've got to be active in terms of asset allocation. Don't just invest in gilts, don't just invest in corporate bonds, EMD, high yield, short duration debt, and be active across those different instruments.
Of course, it's easy for you to say that. For the retail investor, it's best to outsource that sort of asset allocation. Multi-asset becoming increasingly popular with advisors and investors for doing just that, for taking the risk out of their hands.
Yes. I think we've seen, we've seen huge growth in multi-asset funds, and that's really been driven by, I think, the increasing landscape of risk profiling. Risk profiles are everywhere now. Every advisor uses a risk profiler, and the managers that have been able to target those risk profiles appropriately and deliver a solution which is suitable both now but also on an ongoing basis have been the winners.
Justin, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.